the center of the global financial system sits a promise. Not a weapon, not a treaty, a promise. Promise that the United States will always pay its debts. For decades, that promise has been treated as close to sacred. U.S. Treasuries are called risk-free. Banks use them as pristine collateral. Pension funds rely on them for stability. Foreign governments park trillions in them as reserves. When panic hits global markets, investors don't run away from treasuries. They run toward them. But what if that assumption breaks? What if the U.S. Treasury market, the foundation of modern finance, stops being risk-free? This isn't a theoretical exercise anymore. Federal debt has surged past $30 trillion. Interest rates, after years near zero, have climbed sharply. Political fights over the debt ceiling have flirted with technical default. Foreign central banks have reduced their holdings at the margin. And for the first time in a generation, investors are openly debating U.S. fiscal sustainability. If treasuries wobble, everything else moves. To understand why, we need to understand what a treasury actually is. When the U.S. government spends more than it collects in taxes, it runs a deficit. To finance that gap, the Treasury Department issues bonds, treasury bills, notes, and bonds with maturities ranging from a few weeks to 30 years. Investors buy them. In exchange, the government promises fixed interest payments and the return of principal at maturity. That's it, no drama. Just IOUs backed by the taxing power of the U.S. government. Because the United States issues debt in its own currency. And because the dollar is the world's dominant reserve currency, treasuries have long been considered the safest financial asset in existence. In textbooks, they are the risk-free rate. In financial models, they anchor everything from mortgage pricing to stock valuations. But the label risk-free is doing a lot of work. Risk-free in what sense? Credit risk. Historically negligible, the U.S. has never defaulted in the conventional sense. Liquidity risk. Treasuries are among the most liquid securities in the world. Currency risk? If you hold dollars, there's none. But that does not mean zero risk. There is inflation risk. There is political risk. There is market risk. Increasingly, there is fiscal risk. Let's break the system down step by step. The Treasury issues debt at auction. Primary dealers, large financial institutions, are obligated to participate. After issuance, bonds trade in a deep secondary market. Yields fluctuate based on supply and demand, inflation expectations, economic growth, and central bank policy. For years, one buyer dominated the market, the Federal Reserve. After the 2008 financial crisis, the Fed began large-scale asset purchases. It bought trillions of dollars in treasuries, pushing yields lower and injecting liquidity into the system. During the pandemic, those purchases accelerated. The Fed's balance sheet expanded dramatically, and the largest price-insensitive buyer in the world is purchasing your debt. Financing is easy. Then inflation returned. The Fed pivoted. It raised short-term interest rates aggressively. It stopped expanding its balance sheet and began allowing bonds to mature without reinvestment. A process known as quantitative tightening. Now the private market must absorb more issuance. And issuance is rising. The United States is running large deficits, even in periods of economic expansion. It means more bonds hitting the market year after year. At the same time, interest rates are higher. When older, low-interest debt matures, it must be refinanced at current rates. Here's where the math becomes uncomfortable. If federal debt is roughly $33 trillion, and the average interest rate rises meaningfully over time, annual interest payments can climb into the trillions. Already, interest expense is one of the fastest growing components of federal spending. Interest does not build bridges. It does not fund research. It does not provide health care. It pays bondholders. If interest consumes a larger share of the federal budget, the government has fewer options. It can raise taxes, cut spending, borrow more, or tolerate higher inflation to erode the real value of the debt. Each option carries consequences. Bond markets know this. Investors buying a 10-year treasury are not just betting on repayment. They are betting that inflation will remain contained, that political dysfunction will not derail fiscal policy, and that the United States will maintain relative economic strength compared to alternatives. For decades, that bet looked easy. But cracks have appeared. In 2011, during a heated debt ceiling standoff, The credit rating agency Standard & Poor's downgraded U.S. sovereign debt. Markets wobbled. The downgrade did not trigger a collapse, but it was a symbolic shift. The idea that U.S. debt could be questioned at all was once unthinkable. Fast forward to recent years. Political polarization has intensified. Shutdown threats have become routine. Fiscal packages have grown larger and more frequent. Meanwhile, long-term demographic trends, aging populations, rising healthcare costs imply structural spending pressure. Investors are beginning to ask harder questions. Now imagine a scenario. Foreign demand for treasuries weakens. Large holders such as China or Japan reduce purchases at the margin. Domestic banks, facing regulatory changes or balance sheet constraints, step back. The Fed remains committed to fighting inflation and does not immediately resume large-scale bond buying. Supply rises, demand softens, yields move higher. Higher yields mean lower bond prices. Existing holders take mark-to-market losses. Banks and funds that use treasuries as collateral see the value of that collateral fluctuate more aggressively. That volatility matters. Treasuries sit at the core of the global collateral system. They underpin repurchase agreements, short-term loans between financial institutions. They serve as the benchmark against which corporate bonds, mortgages, and even emerging market debt are priced. If the risk-free rate becomes unstable, pricing across the financial system becomes unstable. In 2020, at the onset of the pandemic, even the Treasury market experienced severe liquidity stress. Yields swung sharply. Dealers struggled to intermediate trades. The Fed intervened aggressively to restore order. That episode was a warning. The safest market in the world can seize under pressure. Now consider the psychological layer. Why are treasuries called risk-free? It's because everyone else believes they are risk-free. It's a coordination equilibrium. Banks hold them because regulators treat them as safe. Pension funds hold them because models assume stability. Foreign governments hold them because they need dollar reserves. Financial models discount future cash flows using treasury yields as the baseline. If confidence erodes slowly, the shift might look manageable. Yields drift higher, volatility increases. Markets adjust. But if confidence erodes suddenly, due to political crisis, uncontrolled inflation, or fiscal shock, the repricing could be sharp. And here's the paradox. If yields spike too quickly, the government's interest burden rises even faster, worsening deficits. That dynamic can create a feedback loop. Higher yields, larger deficits, more issuance, even higher yields. To break that loop, the central bank might feel pressure to intervene. But intervention, especially if driven by fiscal stress rather than economic weakness, risks blurring the line between independent monetary policy and debt monetization. And that risks inflation expectations. It becomes a delicate dance. Publicly, officials reassure, the United States has deep capital markets. The dollar remains dominant. There is no credible alternative of similar scale and liquidity. All true. But dominance is not the same as immunity. The uncomfortable reality is that risk-free does not mean free of consequences. It means low probability of default under current assumptions. Those assumptions include steady growth, controlled inflation, political functionality, and global confidence in the dollar-based system. Change the assumptions, and the label changes. Now widen the lens. If treasuries lose their unquestioned status, global capital flows shift. Reserve managers diversify. Risk premiums increase across asset classes. Borrowing costs rise not just for Washington, but for households and businesses. Mortgage rates move with treasury yields. Corporate bond spreads build on top of them. Equity valuations rely on them. The ripple effect is enormous, yet there is a counter-argument. The United States remains the world's largest economy. Its financial markets are unmatched in depth. In times of crisis, capital still tends to flow into dollars. Even during political drama, investors often conclude that alternatives are worse. In other words, treasuries may remain the least risky asset in a risky world. That is not the same as risk-free. The shift from risk-free to least risky is subtle, but it matters. It implies higher structural yields, greater volatility, more frequent episodes of stress, a higher cost of capital for the entire economy, all because the foundation moved slightly. So what if the U.S. Treasury market stops being risk-free? It probably doesn't collapse overnight. It probably doesn't trigger immediate chaos. More likely, it evolves. Yields price more uncertainty. Investors demand a premium. The era of effortless borrowing fades. Fiscal choices become more visible. Monetary policy becomes more complicated. The promise at the center of the system remains, but it is no longer taken for granted. And when the world's benchmark for safety starts to carry visible doubt, the question is no longer whether risk exists. The question is who absorbs it.